Just as a reminder to everyone, this is being recorded. So anyone who registered is going to get a copy of the recording. So folks who aren't here, who did register, they'll get a chance to see this too. Um, just a quick intro at the top. So here's who's on the call. We've got Chris, Brett, and myself. Chris and Brett are both certified financial planners. They lead our advisory team. My name is John. I run portfolio management and the investment side of our wealth unit. And we're all going to be participating in this discussion today. So we hope that you find it valuable, that you find it useful, that you learn something, and hopefully that it helps you. Right off the top, we have to make these disclaimers. This is educational. It does not take into account your circumstances as an individual, so please keep that in mind and consult with an advisor who knows you and knows your situation well. Um, with that said, let's jump in. So SecFi, just as an introduction, we've got a few different ways that we work with folks. We have some DIY tools on our website you can use. Sign up for an account and you can do some planning and scenario testing of your options and the taxes potentially associated with exercising and selling. We do financial advisory and wealth management. That's the team that Chris, Brett, and I are on. We help folks who are primarily folks who are equity compensated at both public and private companies plan their finances and invest their money in a way that's complementary to what they're doing in their companies. So oftentimes people have a large asset, which is their company stock, and we want to help people make the most of that asset and build the rest of their financial life around it too. We also have financing that is available to select companies that allow it to go forward, that have been underwritten and approved by our investments team. I think probably not relevant for this group at the moment, but maybe in a select few circumstances it might be. So those are the ways that SecFi works with folks. Just to jump into why we're here today, well, the reason is Rubrik filed for an IPO, and there was actually some news this morning that the range of prices has been set. So what they're estimating right now is the public offering price might be somewhere between $28 and $31. So it's becoming more of a reality every day. But I put this IPO timeline in here just to give you a sense of where you're at in the process. So you filed your S1. That's, step one in the official process of going public. Generally, after you file an S1, a few weeks or maybe even a few months go by before the company embarks on what's called a roadshow with the bankers. So the bankers are the folks that are, going around the country, around the world, and with management of the company, pitching potential investors on purchasing stock at the IPO price. So that's what that roadshow is. And they may be in that process right now. In fact, it wouldn't surprise me. Oftentimes, the way that they come up with those indicative, range of prices of what they expect the IPO to go out at, it's based on the results of the roadshow, of gathering interest from folks at different price levels. After the roadshow is complete, usually there's a couple weeks go by and the initial offering happens. That's when the company sells shares to the new investors who are buying it at the public offering price. A few hours later, typically, the stock is listed on the stock exchange and can begin trading freely between folks who have shares and people who don't have shares who want them. So that's what you see when the stock opens for trading. Usually it's not at the beginning of the day. Usually happens sometime in the middle of the trading day when a newly IPO'd stock first starts trading on the exchange. 180 days later, roughly, employees, insiders are able to sell after their lockup expires. So most of the time, insiders are locked up or prevented from selling shares for a period of time until post IPO, and generally that time frame lasts about 6 months. So anticipate that, but check out, pay attention to the direction that you'll receive internally. This 180 days is a standard, but it's not required. So the particular circumstances of the lockup may be different depending on what gets decided for Rubrik itself. All right, so we're here to talk about equity and trying to make the most of it. It can be complex. So there's a lot of jargon, a lot of three-letter acronyms, and a lot of ways to, a lot of trade-offs to make as you consider exercising and potentially even selling the shares that you exercise on the exchange once it's publicly traded. So hopefully we can demystify a little bit of this for you all. But please don't hesitate to ask questions along the way. We're going to try to leave some time at the end for questions, but please, along the way, send in your questions via the chat or via the Q&A, and Chris, Brett, and I will try to handle those as they come in. So how should you handle your equity? We're here today to educate, but that's not the end of the road. You should take this information, think about it, apply it to your personal situation, and make a plan. Execute that plan and potentially monitor and adjust depending on what happens in the market and what happens in your personal life. Knowing what to do is not enough. You actually have to do it. So we're here to encourage you to learn what to do and then to make a plan to do that. So before jumping into everything, I wanted to ask this brief question. How much do you know about equity compensation? And I have a poll, but in the interest of time, let's just take this as theoretical and think to yourself, do I know next to nothing? You've done a bit of research, but you're not an expert, or you know a lot already. We're going to try to speak to every level here. But usually this helps us sort of gauge where the audience is at. But in the interest of time, I'm going to skip the actual poll itself. So with that, I'm going to turn it over to Chris, who's going to take us through the forms of equity compensation and taxes to start, and then Brett will take over after that. So Chris, take it away.
Thanks, John. And it's good to be with the folks from Rubrik. I know this is a really exciting time. I'm sure there's been quite a bit of chatter, in the Slack channels, and some company events. So hoping this is just the start, and want you guys to feel just empowered and confident as you go through the IPO process. So, to start, there's a couple main forms of equity compensation. Some of this is going to be dependent upon when you joined Rubrik or your tenure with the company. So start with the two on the left-hand side. Those are options. So you have incentive stock options, or ISOs, and non-qualified stock options, or NSOs. And simply what this means is you have the option or the right to buy shares in the company. And that is going to be at a certain price known as your strike price. If you've joined Rubrik more recently, as companies get more mature, the most common form of equity that is issued is known as restricted stock units, or RSUs. And at private companies, these are typically going to be known as double trigger RSUs. Simply what that means is they're going to vest over time, those units. So a time weighting vesting schedule. So that's trigger number one. And then because it is a privately held company, that second trigger is going to be a change of control where you could get some liquidity. So that could be an IPO. That could be an acquisition of some form. But as we'll get into the taxation piece, the reason it's set up as a double trigger is so that you don't have a tax liability without having the liquidity to be able to pay that tax. There are some differences on the tax treatment on ISOs and NSOs, which I'm going to dive into more on the next slide. All right, so the taxable events. I think we speak with a lot of folks at startup companies, and startup equity can be just mystifying, especially if this is your first time working at a startup company and being granted equity. So I want to start with the types of options. So ISOs and NSOs. So you'll see here, vesting is going to be, one key event. There's no taxes due on that. So when you join a company, you're typically going to be granted an option package that will vest over a period of time. A 4-year vesting schedule is going to be a common, cadence. And so when you vest, nothing happens. Now, when you take action, the first taxable event could be the exercise event. For ISOs, the type of tax that may be due when you exercise an incentive stock option is known as alternative minimum tax, or AMT. Now, one of the incentives of having incentive stock options is you can exercise a portion of these options each calendar year and not incur any kind of tax. What's going to be a big driver of that is going to be the bargain element of the option, and that is that spread. So the 409A, or the fair market value of the company, minus your strike price, that is going to be, one of the biggest drivers of what would incur. Do you have an alternative minimum tax liability, or could you stay below that threshold? You'll notice below that on the non-qualified stock options, that same bargain element is going to be subject to income tax. And that is going to be a guarantee. So with ISOs, you could exercise some without incurring any kind of tax. With non-qualified stock options, this is going to incur a tax liability. So if you happen to have some non-qualified stock options, you want to be prepared for, in addition to the strike price to buy shares of the company, you also want to be able to have some additional money available to cover taxes based off of your personal income tax situation. The other event with options the taxable event is going to be when you sell that. And the type of tax that is going to be due is dependent upon how long you hold shares. If it's a qualifying disposition with ISOs, you can get long-term capital gains on the sale price minus the strike price. So that is one of the benefits. If you're optimistic on the company, you want to try to get exercised or buy those shares when that spread is small, and you want to get as much of that upside taxed at the lowest rate, which is going to be a long-term capital gains rate. And for most folks, that rate is going to be lower than their income tax rate and also the AMT imposed. On NSOs, the sale price minus the 409A when you exercise those options is going to be subject to a long-term capital gain. So if there's a pretty large spread right now between the 409A and your strike price, you'd have to be really optimistic to take some action of exercising non-qualified stock options, because there's going to be a pretty healthy tax likely, and then you only are able to get that preferential tax rate on additional upside from the company's price today. So just keep that in mind. There are some nuances between ISOs and NSOs, but the exercise event and then the sale event are going to be the two types of taxable events with options. On RSUs, when those vest upon hitting that second trigger, the number of units times the share price for Rubrik when the company does have that triggering event is going to be subject to income and income tax. So just like your salary, it's going to show up on your pay stub, it's going to show up on your W-2 tax form, and it's going to be taxed based off of your household income tax bracket for the year. So something to keep in mind is we talked about a preferred long-term capital gains rate if you meet certain criteria with the options. With RSUs, you do not have that same treatment on the vesting. Now, if you hold the units that have vested beyond a 1-year holding period, you could be able to have that upside tax at a long-term capital gains rate. But I think it's important to note that RSUs, when they vest, it is indeed subject to ordinary income tax. All right. So another question that we receive, commonly from startup employees, what the heck is a 409A valuation? So let's start by what is it not? So it's the value of, common stock. And another term that I think is also thrown out that some people may not have heard of, but they see in the headlines is like, Rubrik raised money at a $4 billion valuation. That is referred to the preferred price, or what investors are paying for the stock at the fundraising round. And that is going to be oftentimes separate than what the internal valuation is for the company. One reason is because investors are buying preferred equity that they hope to convert into common shares. But because that is preferred equity, there are some preferences. And so that is typically going to be at a premium price. But the valuation of common stock is known as the 409A valuation. It also may be referred to as the fair market value, or FMV. For Rubrik, that most recently was a little north of $28. The most recent one. If you are able to exercise some before the company does list, it could be favorable, as John mentioned in the S1 document that was updated this morning. That range that they're targeting is between the $28 to $31, so pretty close to kind of where the current fair market value targets today. But we've seen there's some IPOs that that initial price is actually significantly lower than what it is listed at. So it depends upon your situation, kind of your outlook, but the 409A is also known as the fair market value. And for private companies, that is going to be one of the big factors on what influences that spread. When the company is publicly listed, it is just the fair market value, or what's going to influence the tax implications when you exercise, is going to be the fair market value when you exercise, when it's trading, minus the strike price of the option. The strike price will stay consistent throughout.
Yeah, I think that's really important to hammer home, Chris. Like, this 409A valuation is only applicable until the stock is public. So once the stock is public, there's no more concept of a 409A valuation. Now the number that matters is the price of the stock, trading on a public exchange, observable. So this number matters if you have a chance to exercise before the IPO. I don't know if they will open a window or not. But that we wanted to make that distinction, or at least educate about what that is, just in case you do have an opportunity to exercise before IPO, and you can think about whether or not it makes sense for your situation.
Good clarifying point. So another point we want to say is just not all taxes are the same, and you can see here that there's quite a few different types of tax, and also there's tax on a federal level, there's tax on a state level. Those vary by state. California is one example that we have here, has some pretty high taxes. If you are located in another state, it's important to use that. And also, I will note that if you have lived in multiple states during your tenure at Rubrik, and you have been granted options or granted RSUs, where you lived when you vested those shares or those options is going to be an important factor to consider for your tax situation. So those can be more complex, something you definitely would want to engage a tax advisor for. But I think the takeaway here is they're not all the same. You can see income tax and short-term capital gains tax, those rates are going to be consistent. So those are going to be some of the highest. AMT, you only have 2 rates, and that range is going to be the smallest. Some states also impose a state level AMT. California is one of those. Most states do not, though. So if you do have incentive stock options that you have not yet exercised, and you live in a state that does not impose that, that's something that 6.65, it may not be applicable to you. So something to keep in mind. The other thing that I would say is, AMT, it can be pretty scary and daunting to think about. I'm sure there's people that have probably shared some horror stories, but you can recover that type of tax in the future. It's not dependent upon Rubrik going public. Now, Rubrik going public at a higher price than what you exercised the option at can help accelerate the recovery of that. But you can get any alternative minimum tax that you have paid. You can receive that back in the future via tax credit. And again, why you would exercise the option and potentially incur a tax liability today would be to try to set yourself up for that long-term holding period, which again is going to, if the price continues to go up from here, it's going to set up for that additional appreciation to be taxed at a lower rate. And you can see on a federal basis that can range from 0 to 20%, so a lot lower than the 37% on the income tax. And then some states will also have a separate capital gains, long-term capital gains schedule that differs from their income tax rates. And then the last point that I want to make before I turn it over to Brett is, so really if you have options in Rubrik, you have 2 choices to make, and there's trade-offs to each. And I think that's the biggest thing that I try to stress when I'm speaking with folks is there's not a right or wrong, and what one of your colleagues is doing, is not necessarily the right decision for you. He or she may have been through an IPO at another company before, or they may be in a vastly different financial situation than your current circumstances. So I think it's really important to not be influenced by what others are doing, and really try to just understand, what are the implications of taking action today, and then is that wise for me and my family? And also be aware of the potential downside. If Rubrik stock doesn't perform the way that we're hoping it to be, then we don't want that to be devastating or to set you and your family back from anything else you're hoping to achieve. So your two main choices are: do you exercise and hold, exercise the options and hold shares? The pros are you can, one, continue to be exposed for additional upside. So if the IPO price pops and is higher by the end of the lockup period, then that additional exposure could potentially be taxed at a lower rate. The drawback is, if the price declines, well, you may have incurred a known tax liability, and then the asset that you are then holding on to has a lower value than when you exercised it. You also got to put up the money, and there's some opportunity costs with that, because money that is in your savings account, or money that's in investments, or money that you could just be used to take a trip with your family, there's value to that. And so are you willing to part with that money for the opportunity to potentially get a lower tax rate if the price goes up in value? If you're not willing to, then doing what's called an exercise and sale, or a cashless exercise, could be a really good route for you. It is going to help reduce your concentration risk, and you don't have to front the money, which is nice. You just basically wait until the lockup period is over, and then you say, you know what, I'm going to sell a portion of my shares to cover the taxes associated with getting exercised, and then whatever net shares are left as a result of that, that's going to be mine to keep. And I could have all those sold. I could keep some of those net shares if I want a little bit of exposure. That choice is yours. But you don't have to come up with the money from personal assets to get exercised and pay any tax. You don't have the upside exposure with that route if you choose to cash out on everything. And it is going to be subject to higher potential taxes, and not subject to that long-term capital gains that we went over on the last slide.
Yeah, I would just like to add there on that slide, Chris. Just when we talk to people here, there's always the risk reward metric here, right? And when you think of your equity, on the lowest risk side, it's essentially you do nothing, right, until the company goes public. The pros to that is you get to see what happens, right? And you get to feel it out. You get to see what the company becomes. The downside, as we said, probably the highest cash outlay, right, at that time. On the full other end of the spectrum, right, you might know some individuals who exercised everything as soon as they got in the door, right, and they took a lot of risk. So the downside there is things may have not worked out. Obviously, in this situation, it looks like it's going to work out pretty good. But for some companies that doesn't happen. The pros to that is that there's the upside, as well as probably a much lower cash layout, right? They're probably going to win the tax battle, as Chris talked about, with long-term capital gains treatment there. So just wanted to quickly add that. We can move on, John. All right. So now that we've talked about all the fun stuff around taxes, now we actually have to fit this into your greater financial picture. So what actually goes into an exercise or sales plan? At the highest level, your whole financial picture. Okay. That's the easiest way to overlook it. We made a list of the most common things that we do see people come across, but it's probably easiest if we just pick a couple here and just really show you how that actually plays out into most of the folks that we work with scenarios. So really let's look at one of them to be, let's look at probably personal balance sheet. That's always a strong one that comes up. And the big one that comes up there is concentration risk, right? You may be looking at your personal balance sheet and thinking, Rubrik's 80% of my net worth. And that is not uncommon at all, right? That is very common for folks that are at pre-IPO companies. Okay. And there's nothing wrong with that. It's now, how do we have a game plan, okay, around this concentration risk to maybe diversify once we have the opportunity? Okay, so what are we thinking through? Using an example of this, let's say 50% of your net worth, million net worth, 50% of it is in your company stock. If the company goes public, the market goes down 20%, you've lost $100,000 in your portfolio, right? That could be, it's about a 10% decrease in your net worth. When we talk about the personal balance sheet, once we have the opportunity to get liquid, okay, and create the diversification plan, we have to figure out what fits into your picture, okay? What is going to make your financial life a success to you and yours, okay? You and whoever you plan with. So if we look at that same example and we have your concentration risk or level maybe like 10%, that same 20% reduction is really only about a 2% tax hit to your net or overall hit to your net worth, right? So the power of diversification is really key. And we'll talk later in some of these slides. When you go through these type of events, it becomes really powerful to be a good steward of the financial situation you have going for you. I'd say maybe like the second thing that we see a lot, obviously is taxes, but we've talked a bit about taxes, is kind of career plans, right? While some of us hope to be at our companies forever, most of us don't, unfortunately. So just be aware of, what the exercise provisions are for your company. Understand that if you are going to leave, how does that fit into your picture? Are you going to be leaving options on the table, right? What are going to be the provisions around them? How much time do you have to purchase them, buy them, exercise? What does the tax implication come along with that? Long story short, a lot of these things that are listed here, they all talk to each other, right? So making one decision in one category here really impacts another bullet point that's on this list.
Another thing I would just chime in there on that list, it's not necessarily an exercise or sales plan, but I think one thing to note for some of the clients that we've worked with that, have been at a private company that has gone public, over the past year or so, or even before that, is, there's companies sometimes roll out new benefits for employees now that the company is public. So like one, for example, is an employee stock purchase plan. And the reason I mentioned is there could be ways for you to continue to get exposure or have exposure to Rubrik stock if you would want to, if you think that there's upside potential without having to take the risk of exercising and holding shares if that just doesn't fit with your personal comfort or just other kind of life plans. There may be some other benefits to roll out, but that's something that has been common for public companies, that you actually may be able to purchase some shares at a discount relative to the current price. So I won't dive into that on this one, but just something else to keep in mind is there may be some new opportunities to have equity exposure even after your company is a publicly traded company.
Yeah, that's a great point. Great point. Awesome. So should I exercise my Rubrik stock options? As we've just kind of talked about, it can be what you consider a loaded decision. So on the slide here, we have a little bit of an exercise plan overview, just a snippet of some of the due diligence that we do with our clients to determine all of these things, right? There's so much that goes into it. How does it fit on my balance sheet? Am I over concentrated? What's going to be the cost, right? Not just to purchase it, but to pay the taxes, right? So making sure we have the money for that. Does holding for the long-term capital gains make sense for me? Does it not make sense for me, right? Everybody's individual situation is going to look completely different, okay? So while it's great to talk to others to get education on your equity, plopping that into your own personal situation is just highly individualized, right? So a lot of the things that you need to think through on should I exercise my stock options would be, do I have that cash, right? If I do, where's it at? Is it in a brokerage account? Can I go to it without possibly creating short-term capital gains, right? Do I have to sell inside of a brokerage account to get some money out, right? Do I incur tax for doing that? Do I have an emergency fund set up already, right? Those kind of things matter and come into play. Then having just a tax plan in general to say, when are my taxes going to be due? Am I going to incur alternative minimum tax? Okay. Where do I pay them? Am I paying quarterly estimated tax payments for things that happen because of sales? There's a lot of moving parts that go into these. But in your situation, it could be extremely beneficial to potentially, if a window is open, exercise earlier if you are bullish on the company. Here we wanted to do just a little bit of like how you actually purchase the option, right? So how do you exercise the option? Really, you'll log into the custodian where your equity is going to be held. Once you, depending on where Rubrik is holding all of their stuff for each individual, you will log into your custodian. Essentially what happens is you are paying the company the strike price, okay, to purchase your option on that exercise date. So when you were granted the equity, you were given a grant price, otherwise known as a strike price. That is going to be your cost to purchase. Okay, so you will pay the company strike price at that time. Now, as Chris mentioned earlier in the tax stuff, you may owe the company a portion of your taxes. Okay, so if you do have like non-qualified stock options, that fair market value or the 409A minus your strike price could be taxable. Okay, so you could owe taxes at that juncture. With incentive stock options, you may have a tax-free exercise, meaning you did not pay alternative minimum tax or you do not need to. You may bump yourself into the alternative minimum tax, which could be a fitting situation for your individual circumstances. But at that time, you would have to plan for an alternative minimum tax bill being due. Step 3 here is once you do all of that, you do own the shares. You are now a holder of the shares. You have exercised the option. Okay, you have exercised your right, and now you hold the shares. Depending on your trading strategy, your sales plan, where you go from there really depends here in step 4, but you'd be paying the remainder of your tax bill over the course of the year, potentially via estimated payments, or you'll be paying at year end, in the following calendar year when you file your taxes. That could be a very much of a changing number, as we see is once the company does go public. There'll be a lot of variation in the stock price, right? It'll be trading on a day-to-day venture. Once the lockup period is open and you can execute your sales, it'll be really crucial to understand what are the taxes that are being incurred based on the strategy you're going to put in place. So the IPO happens, now what? What we have on the right side here is really a snippet of some of the planning we do for a lot of our clients. What's key to take away here is that this is a life-changing event, okay? Whether it is at a massive scale from a asset situation, or if it's what some people would say is a milder event. Either way, you've gotten to an IPO. Very few people get to say that, and there's going to be some life-changing things that happen for you. As we talked about before, how does this fit in my situation? So we see a little bit of a 91% there. That's just what's called a Monte Carlo. We won't get into that today, but essentially what we want to focus on is, are you working to build the life you want? Are you utilizing these assets to build the life you want? So it's important that you have a full view of what is my effective tax rate? What's my savings rate look like? Am I maximizing the benefit of all of those things? What does my balance sheet look like? Right? Do I have a place to see all of this stuff? Right? Because a new windfall can make our minds very busy when we're looking at our accounts. So it's very important to have a one-stop place for all of that. So you have to put into a plan here, right? As we'll see in a later slide, there's a lot of decisions to be made. So do I need to sell my RSUs, options, or what comes first, right? Which is like the best tax situation for me. Sometimes it's not the best tax situation that you really are looking for, right? Sometimes it may just be the proceeds that you're looking for. Maybe it's a new home you want to buy, or a pool that you want to get put into place, or education that needs to be paid for. So you need liquidity quicker. So really it's, how do we think through these things? Okay. How much of it do I sell? Again, concentration risk comes into play there. One of the things here is, am I double taxed? Okay. So that could be meaning, if I had RSUs and they vest to me on the IPO date and then I hold them, I'm creating a second tax event. That's the same thing that can happen with your options, right? You could have the purchase date could be a tax event. And then upon the sale is that second tax event. Okay. How does that work? If you've paid AMT, it's always advantageous to have a plan for how you're going to get that back. Okay. So as Chris said, AMT sometimes gets a bad rep around things. But there are ways to get back AMT, and one of the quickest ways to do it is sell incentive stock options that created the AMT tax bill. So how are we going to do that? What does that look like in my tax situation? And how fast can I recoup those credits? And then I kind of hit on, what do I do with the proceeds? What is really the desires that you and those that you're planning for have, and that helps build the strategy around the IPO.
Thanks, Brett. So a common question we get is, what's actually going to happen on IPO day? And nobody knows. There's a big blue number on the right-hand side of the screen. Typically, IPOs go up on their first day of trading. That's the empirical result of looking at thousands of IPOs across 40 plus years of data. In general, IPOs tend to have a pop on the first day, and the average pop is 19%. Now, average, you can drown in a river that's 2 feet deep on average, right? Like the average gives you a good expectation, but it doesn't tell you what the range of possibilities are. And the range of possibilities with any single stock, whether it's IPO or something that's been trading for years, the variance is very wide. There can be all sorts of things that happen. So expect a 19% pop, but also expect a lot of uncertainty around that potential pop. Reddit is our most recent high-profile example of an IPO. They had a very nice pop on the first day. I think they traded as high as $70 a share, or in the 60s. And now they're back down to 40, but that's still way above the IPO price. So it's not uncommon for stocks to have an initial pop on the first day and to stay above their IPO price for a while. It also happens in the other direction. Like Facebook is a famous example. They had what's called a busted IPO. When they IPO'd, the stock price dropped. It was not anticipated. We know with hindsight what happened from there, but at the time people were freaking out. So I guess the point of this is to give you a little bit of an idea of what to expect, what's the average experience, but to also drive home that there's a wide range of things that could happen, and you should be prepared for either of those for any situation. When you're thinking about exercising and selling your shares, or exercising your options, selling your shares, you've got to make trade-offs. That's what this is all about, is making the right trade-offs. And what you want to do is have the information necessary to make the trade-off. So what I'm showing here is a little example analysis that we do for clients sometimes that helps them decide whether or not they should postpone selling the shares that they own until they reach the long-term capital gain threshold so they get the lower tax rate, or should they sell them today and pay a higher tax rate? And the thing that you need to know in order to make that decision in an informed way is what do I net in either situation? And that's going to depend on your personal tax bracket. It's going to depend on the cost basis of the shares that you own, and you may have shares at different cost bases. So here I'm showing 3 gray bars. The right-hand side is the axis for these gray bars. This person has 9,000-ish shares at about $28 share as a cost basis, and at a $50 stock price, that means that they're indifferent between selling today for 50 and getting taxed as a short-term capital gain, or selling once they reach long-term capital gains at about 45. Those two things are equivalent from a net dollar standpoint. And the question you have to ask yourself if you're in this situation is it worth the risk to hang on until I get to long-term capital gains to save $5 a share? And what that number is, it's going to depend on the stock price, going to depend on your cost basis, going to depend on your tax bracket. But it's very important to know what the trade-off is so you can actually make an informed decision. And that's what putting together a plan is all about.
I think on that
So,
page, just like one thing I would chime in is if you have incentive stock options that are at a pretty low strike price, think $1, $2, $3, $4. Let's say, Rubrik goes public at $30 a share, just for round numbers, it's within that range. Like that has a pretty significant margin of safety or pretty significant bargain element. And those are going to be the ones that have, I would say, the bigger opportunity are going to be the most compelling to potentially hold on to. For maybe if you've been at Rubrik for a while and you have some options that were granted at a higher strike price, those are going to be ones that are maybe there's just the juice isn't worth the squeeze in terms on holding on, just because you could get a lot more if you exercise some of those earlier grants, just because that what is going to be subject to that longer term capital gains rate or the lower rate is going to be significantly larger, and therefore would help net you more. So anyways, we could kind of run the numbers for folks, but I just wanted, if there is anyone out there that has multiple grants and they're trying to decide, if I was to exercise some and hold on to it, should I do an earlier one? Should I do a later grant? And typically the larger that, kind of that spread is, the more advantageous it is going to be to try to hold on to that to get that longer term capital gains rate.
Awesome. Thanks for that additional color, Chris. So the next slide here is an illustration of a very high level sales plan for your stock. And what we put on the left-hand side is the why you might want to sell some stock. And that's frankly where it should start. You should make decisions with your goals in mind. And so in this particular case, this is just a silly example, but this person has a desire to buy a home, and they're going to need 250 grand for the down payment. So that's one of their money priorities, and so on down the list. They own Rubrik's Rubrik shares or options, and they've determined how much they would sell at different price points. And they've determined, what that nets them in cash at those different price points and what that allows them to do in terms of achieving their goals. So, the point of this slide is not to tell you that this is the way to do a sales plan. It's to enforce and drive home that you should have a plan, whether that plan is based on price triggers at which you sell a portion of shares, or it's based on a period of time, or it's based on something else. The important point is that you create a plan going in, and that plan is driven by what you actually want to achieve in your life. When you go through an IPO, it's going to be a little bit stressful. The stock's going to bounce around, might be a little bit scary. You might be checking your stocks app like 15 times a day, looking at the price. I wouldn't recommend it, but I know it's very hard not to do. So, the point of this is make a plan and stick to your plan. You don't want to have to make decisions in a stressed situation where there's data flying at you and opinions flying at you. Take a step back and think about it first and put together a plan. Align it with your goals. At SecFi, if you do choose to engage with us and you want to become a wealth client, one of the things that we'll do is work with you on creating this plan and even potentially executing the plan. We do that on behalf of our clients who have gone through IPOs in the past, where we'll just take the sale of the stock out of their, off their plate altogether and execute on the plan for them. So just an FYI there that service is open. So on that note, I think it's a good a good time to talk about determining your why. And I'm going to kick it over to Brett to take this conversation.
Yeah, John just kind of mentioned there, a perfect segue of there's a lot of decisions that are going to be made here. Okay. And there's a lot of trade-offs. So this graph here is actually a perfect placement for it. And I would urge that while the S1 has been filed, the time to start doing this is now, right? As things kick up, okay, and the date gets closer, having a plan beforehand it's just instrumental in feeling better throughout the process, right? Because you're able to determine what you would like to do, okay, in different scenarios. So when we do a lot of the planning with folks, a lot of the analysis that's done is showing prices at different situations at different price points, right? And the idea behind that is you want to have strategy for the things that could happen. Okay. So there's going to be the plan in place, but there is also going to be that plan B, right? That happens if things don't go as well as you thought, or maybe a plan C, things go way better than you thought, right? And you love the price. So what we really want to do here is limit the amount of decisions that have to be made once you have the freedom to start taking action. Okay. So this time period, before, while the roadshow is going on, right, and before everything happens, it's really important, right, to get all those things in place. So really determining your why. I'm sure you're asking yourself, like, what exactly does that mean? To us, it means a lot of things around what do you value? What do you want out of your life? What does this type of event mean to you? Okay, from a financial perspective, but also from just a life perspective, right? A lot of times we see people, who maybe didn't travel as often as they wanted to, right? And this is an opportunity, right? So we really want to empower people to, live your best life today and in the future, right? So work to have a plan in place that is going to allow you to do the things that you enjoy today and that you want to do, while not derailing the things that you see for yourself in the future. Okay. We know nothing in the future is set in stone. We know that the future is not a given for many people, which is why we want you to enjoy the fruits of your labor today, okay, while still getting into the future you want. One of the big things is being intentional around your money, okay? So being a good steward around your money. Again, for some people, what are the things that bring you joy? Is it a sabbatical? Is it taking trips? There's going to be a lot of things that come with this wealth, right? So being a steward of the money is, how do you want to leave a legacy, right? So one thing that comes up all the time for our clients is many times estate planning has been put off. Okay, well, this new wealth is an opportunity to get some protections around that money. Okay, so have a estate plan in place. Make sure that your assets are going to people that you would like, okay, in the way that you would like. I'll also add in one of the things that doesn't get talked about a lot that we work with clients is insurance. Okay. A newfound wealth is going to create a new need for insurance. Okay. So we do look at clients' umbrella policies. Long story short, on the umbrella policies, if people know you have money, there's potential you could be sued. Okay. And that's the long story short on it. Umbrella policies will protect you above and beyond your regular coverages. So we do always talk through that with clients, right? Do we have a plan for those kind of things? Unfortunately, we live in a world where they happen. Reduce the financial anxiety. John kind of hit on that. It's going to be a crazy time when this all happens. Do your best to put an action plan in place and understand that you can only control the things you can control, and where the market is going to go is an uncontrollable. Okay. So just having the plan in place will hopefully reduce that anxiety. And then discipline, right? As John said, for some clients, we take over that sales plan for them. And the reason for that is because those clients see the need for the discipline, right? Because maybe they won't take the action, or maybe they're just too busy. And that's actually a lot of our clients, is that they're just too busy. You're all smart folks. So, and you could probably handle it yourself, but many of them are just too busy, and they're just like, hey, look, I need you to execute, to stay disciplined to the things that we are talking about. So just making sure that you have a sales strategy in place and that it does fit into your overall portfolio in general. And then really kind of like the last thing here is just a case study of really like our typical Rubrik employee client. So their current situation, joined in 2018. They hold some unexercised ISOs, and they're wondering if they should exercise any of their vested equity. So the key things, all right, we take a little bit of time before, with our wealth clients, really one of our first meetings is really just finding out, like, what are the key driving factors for you, right? What are the things that are going to drive you to what you view as success? And this individual's key factors were aligning the plan for their equity, for their why. Okay. they have some personal needs like a down payment on a home, some childcare costs for a growing family, and then tax strategy for like optimizing for lowest rates. So just putting this in a little bit in practice, obviously this is very broad strokes, but we see a scenario like this when we look at tax strategy, like optimizing for lowest taxes. The first thing that goes off in my planning brain is if we have incentive stock options, right? John alluded to the break even before, right? We start digging into that analysis. One, if we exercise, are we going to take on an A&T bill? Okay. Is that an optimal situation for this individual? Do they have cash for that? The second would be, what's the risk reward trade-off once we do that? Okay. So we exercise incentive stock options. Now there's the risk trade-off of, do we hold long-term? Okay. And what's like that break-even price, or do we sell and take the short-term capital gain hit, which is basically ordinary income rates for taxation purposes? So, there's a lot that goes into like that kind of conversation. When we then look at personal liquidity needs, down payment on home, childcare costs, before we even exercise, right, we start analyzing where do we stand, right, from a cash situation for all of these things, right? What is most important to the individual? For some people, it may be more important to them to actually save cash for down payment on a home than to buy their Rubrik equity. And that's because they know if they go public, they'll have that opportunity to get liquid, right? And when they do go public. So a lot goes into play there. And there's a lot of different scenarios that take place. But much like all of these things, they're highly individualized to each specific person. And tax usually rules the day for most folks, but sometimes just having the proceeds can have a huge impact on your financial life as well. Anything, Chris or John, you guys want to add to a usual employee that we work with like that?
Yeah, the only thing I'll add here is like you have multiple priorities. Like every problem you ever face is multi-factor, right? Like you don't choose which restaurant you go to for dinner based on one quality of the restaurant. You don't just sort them by price and choose the cheapest one. The type of food matters, how far away it is matters, the quality matters, the price matters. Like all of these things matter. Same is true when you're making decisions with your options, with your stock. The key thing is to be really clear on what are the implications of any particular decision. And then you can make the trade-offs with eyes wide open and understanding all of the pieces that are in place. So, there's often things that we can do to help optimize and like just make you absolutely better off given a particular course of action. But a lot of the work is also understanding what those trade-offs are and communicating them clearly so that our clients we can work together as partners to make the right trade-off with them.
Yeah, and I would just chime in that, I think we get a lot of folks reaching out that are, really interested on like the tax piece. How can I, what's the strategy that's going to allow me to pay the least amount of tax? And I just want to say that I think, taxes are definitely very like central to like kind of our core approach. Like taxes, typically impact, a lot, if not all decisions. And so it's something that we definitely like want to keep more dollars in your pocket and don't want you to pay any unnecessary tax bills. But as John was showing on a previous slide, some decisions, if you exercise in the difference, the break-even price is like $5 a share. I mean, we have seen that with not just Reddit recently IPO, but like there's a lot of IPOs that a $5 swing in a stock price can happen in a day. And so I think we also really want to just make a decision that gives you like helps you sleep easy at night and really just evaluate, what are the ways that do make sense to try to optimize, and then what are the things that maybe just are not worth it, because at the end of the day, it's about figuring out how do you navigate financial decisions, like what do you want out of life, and we're going to try to help you to do that with taxes definitely in mind, but not the driving force behind all decisions.
Awesome. Well, I know we're close to time here. I wanted to do a little call to action. Please go sign up at secfi.com to use our tools on your own. read some educational material. We've got a lot of content out there that can be helpful as you make these decisions. Or you can even book an introduction call with one of us and talk more about your individual financial situation and whether it makes sense to work in an ongoing way with a SecFi advisor. So we really appreciate everyone's time. Looking at the questions, it seems like we've been able to answer the ones that came in just through the discussion that we had here. And therefore, I'm going to go ahead and call it here, given that we've got 2 minutes left. Thank you all for attending, and we hope to hear from you. And best of luck with the Rubrik IPO. We'll be watching it just like you will.
Thanks, everyone.
See y'all.
Thank you.